What's up guys, welcome to day 2 of the bootcamp. Today we're going to be talking about one of the most powerful concepts in trading, and it is called liquidity. We're going to dive deep into buy-side liquidity, sell-side liquidity, what is the theory behind it, and if you ever felt like the market is playing tricks on you and as soon as you enter it hits your stop loss and then it runs back to your target, then listen to this video because it is definitely going to help you a lot. First, we have to understand how does the price moves. Price moves because of a transaction between an aggressive buyer to a passive seller or to an aggressive seller to a passive buyer. And knowing this leads us to the point number 1. For every buyer, there must be a seller. Now you're probably asking, what is driving the market? Is it institutions? Is it retail traders? And the answer is institutions and their algorithms. Why? Because they have a lot of size. They have a lot of buying and selling power, which can drive the market in both directions. So right here, this leads us to the point number 2. If institutions want to enter a trade, they need a lot of liquidity. Okay, let's say an institution wants to enter 5,000 contracts for buys. They want to enter for longs. Okay, they think price is going to go to the upside. For every transaction, there must be a buyer and a seller. So if they want to buy 5,000 contracts, they need 5,000 contracts to be sold at that exact price. So where is the most and the best area on the chart where you can find all those transactions happening at the same time? This leads us to the point number 3. Where does the liquidity sit? And the answer is above old highs and below old lows. You might be asking, why does liquidity sit below old lows and above old highs? And the reason for it is that the masses put their stop losses below old lows and above old highs. So let's say right here, I want it to be in longs. I would be in long on a buy limit order right here, and I would try to target the most recent high. But let's say this trade does not go my way and it goes and hit my stop loss. If it goes and hit my stop loss, it's going to trigger a sell order because I bought in the first place. So if institutions want to enter with big size, then they want a lot of traders to get stopped out at the same place so they can get filled on their big orders. Now let's say that I'm a bank and I wanted to enter 5,000 contracts of NQ shorts. Okay, I wanted to go short and I wanted to see price go down. So if I know this, I am going to be a seller, and if I want to sell 5,000 contracts, then I need 5,000 people to buy their contract at the same time so I can get filled at a similar price. Now knowing this information, I want to look for an area on the chart where I know a lot of buy orders will be hit and triggered at the same time so I can get filled at a similar price level with 5,000 contracts. And the best possible area on the chart to find this is old highs, because if people get their stop losses hit right here above this old high, it will create a pool of liquidity that just got swept, and 5,000 people will most likely click on buy to get out of the position for a stop loss here, and which could give me an opportunity to go short and get filled with 5,000 contracts for shorts for price to go down after. Now you're probably asking, what is buy side, what is sell side, and how can I identify those levels on my chart? And buy side is nothing else than a swing high, and sell side is nothing else than a swing low. I know it sounds pretty easy, and it is pretty easy in my opinion, but buy side is nothing else than a swing high because you know that there's a big pool of buy stops sitting above this most recent high. This is why we call it buy side liquidity. Same thing for the sell side liquidity. It's called sell side because there's a big pool of sell stops that are going to be triggered once we trade below it, and it is only a swing low like I just described with the buy side. And now let's practice together. We can see that we have a nice swing high here, which would act as my buy side liquidity. Right here, we sweep the buy side liquidity pool right there. So if I was an institution and I wanted to get short, I would try to get short just above this high because I know there's going to be a pool of buy stops that are going to be triggered once we start trading above this high here. So if price starts to sweep this liquidity and shoots down, then you know that institutions got filled on the sell side. So right here we have a nice swing high, which would be my buy side, and right here we created that swing low since we traded above this candle's high here. So this would be my sell side liquidity pool. And right there you can see we broke above the buy side, which means that we did not sweep liquidity, we just broke above it. So then we still have the sell side as our liquidity pool. Right now you can see we formed a swing high. So this would be my buy side and this would be my sell side. So then we see price creating another swing high, which this could be used as buy side again. And this, so we have two buy side liquidity pools and a sell side liquidity pool right here. So right here we sweep that liquidity. So if I was an institution and I would want to be in longs with an insane amount of contracts, then I would want a pool of sell stops to be triggered right below a low, so I could get filled with my 5,000 contracts with a buy limit order right there. So you can see right there we formed a swing low, so this would be my sell side, and then we broke above this buy side right here, so it's no longer a valid buy side liquidity pool. Again, this, once you break above or sweep the high, it does not exist anymore. It's not a buy side because it got swept. Right here we have a buy side liquidity pool. Right here is my sell side. It's just basically swing points in the market. So let's see what it does. Right here we formed sell side. Right here we broke above buy side, which is a break of structure. I will talk about it in another video. And then we formed another swing low here. This will be my sell side again. You can see we formed 3 levels of sell side liquidity, 3 swing lows. So 1, 2, 3. If I was an institution, I would want to see those pools of liquidity get swept, and I would try to enter longs here because I know a lot of people just got hunted under stop, and there is a big pool of sell stop that just got triggered. So if I want to be in the longs and enter for buys with 5,000 contracts, then I would need 5,000 contracts to be sold at this exact price, and the best way to do so is enter below old lows. Well, let's keep going here. We formed a nice low here, which is my sell side liquidity, then swept the sell side. This is my buy side. Now you can see we pushed up, formed sell side liquidity, swept buy side liquidity right there. If I was willing to go short, I would try to short above old highs if I was an institution, because there's a pool of buy stops sitting right above this candle's high here. Let's do other scenarios. You can see right here we formed a swing high. This will be my buy side. And then right here we formed a nice swing low. This will be my sell side liquidity. If I sweep either one of them, I should be aiming for the opposite direction. So right here I swept sell side first. So if I was going to be an institution, then I would want price to hit this low first for me to get filled on an insane amount of buy limits for price to go in the opposite direction. And right here you can see we swept sell side, swept buy side. Let's keep going. Right here, this will be my sell side liquidity, and since right here we formed a swing high, this will be my buy side. Right here we formed a swing low, so this is my sell side again. So we have 2 sell side liquidity pools. Swept buy side, formed other swing lows, sell side again. Right here we have multiple level of sell side. I will talk about these liquidity pools right after in another video also. Right here we formed a buy side liquidity pool. This is another sell side liquidity pool right here. We swept it. If I was an institution, I would be looking for longs once we reject this low here, because there's a lot of sell stops that are getting triggered once we tap this level. So one thing you need to understand about this video is that liquidity is sitting above old highs and below old lows, and if you are an institution, you want to see price trade above old highs and trade below old lows, so a pool of stop orders gets filled so you can trade in the opposite direction. So keep it in mind, every time you sweep buy side liquidity, you want to be looking for shorts, and if you sweep sell side liquidity, you want to be looking for longs. Okay, this is really what this video is about. You need to understand that it's not because we're starting to trade above a high that you need to be bullish. When you sweep a high, you're most likely going to go in the opposite direction if you reject that high, because institutions are looking for these areas, specific areas in price, in order to get filled on an insane amount of contracts to go in the opposite direction. You basically only have to mark out the swing highs and swing lows that are pretty obvious, and you can know where price could be reversing if we reject the level. Thank you guys so much. Hopefully this video helped you out to understand what is liquidity, how does institutions play with those levels, and real live examples. This is just the beginning, introduction, and the second video of the bootcamp. Hopefully this video helped you out. If you had any questions on the framework, make sure to come back tomorrow for the next video. See you guys in the next one. Peace out.